Hello and welcome to the Zawya Podcast. I'm Brinda Darasha, and today I'm talking to Maurice Gravier, who is the Chief Investment Officer at Emirates NBD Wealth Management, and we'll be talking about the outlook for GCC equities. Maurice, in your investment outlook for the year called Low Visibility Ahead, you spoke about having a positive investment outlook in the face of uncertainties. Now, more than halfway through the year, by when do you think the uncertainties will clarify a bit and that investors might be able to take decisions with more conviction?
Yes, we started the year calling for low visibility, high uncertainty and high volatility, but we also had a reasonably positive view. Frankly, we cannot say that everything is much clearer now. The war in Ukraine has been a game changer. It has amplified the pre-existing issues that we had identified, such as rising inflation leading to monetary tightening and slowing growth. What was a threat and a concern is now a certainty. Western central banks are very serious in fighting inflation. It will have an economic cost and it will continue to rock markets but also reshape the investment landscape. So to your question, we are still in an unusual situation when it comes to investment decision making. Our central scenario is less pessimistic than many, but our own level of confidence is not as high as it usually is. In our recommended allocations, we own large amounts of cash. It provides safety but also flexibility. We underweight the riskiest segments of fixed income because they are a bit complacent with the economic outlook that we have, but we selectively and modestly overweight equities, the one with structural growth such as in the US and some emerging markets.
That is very interesting. So cash is king after all. Now the new world order seems to be of deglobalisation alongside inflation, and that is threatening to choke economic growth. How worried should an investor be?
Yeah, inflation is an essential point, and what you highlight is interesting. Well, first, inflation in the US is a matter of the booming job market. Inflation in Europe is about the energy crisis mostly. However, as you said, globalization has been one of the key reasons behind 4 decades of price moderation, and globalization is shrinking. We have had 2 shocks. First, the pandemic. It highlighted how crucial supply chains are when essential goods are produced far abroad. And of course, the Ukraine crisis, which could lead to a kind of a restricted globalization with 2 distinct blocks of countries. It's a concern for Europe especially. If on one hand they don't have cheap energy from Russia and on the other they don't export as many goods to the east as they used to, they are simply squeezed. It's probably more subtle for the US. They reinforce their leadership over the West, and their economic power is strong enough to allow them to invest in local production capabilities. Reshoring is a thing there, as we have seen for semiconductors, for example. Finally, but I would say crucially, this is not an adverse situation for everyone. If you are a country which is between the 2 blocks and wise enough to have good relation with both of them, you're not that in a difficult place. I'm of course thinking about the UAE, with good relations with both the West and the East, an open economy, energy security. It's also a fantastic place to live and work in absolute and of course relatively to a complicated world, so its status as a hub between the 2 blocks is only confirmed.
Coming to the GCC markets, we seem to have done well so far this year, supported by the oil windfall and strong financial results. Year to date, we have seen the MSCI GCC index rise by 8%. What catalysts should investors watch out for in the months ahead?
When it comes to GCC stock markets, there are really 2 distinct narratives because there are 2 distinct levels of expertise. Let's start with local investors. They know the quality of the companies and the sustainable drivers of growth, the pro-business leadership, support for diversification and non-oil sectors, digitalization, tourism, you name it. So these investors, they are already in. It means that incremental money is about international investors, and they don't know the market as well, frankly. So strong oil prices and the global rotation from growth to value have both benefited the GCC stock markets. But if these global factors change, our markets could temporarily have a kind of a setback. The true catalyst, as you ask, is to have more global investors deeply understanding the virtues of our companies and the fact that their valuations are overall attractive. It is the main catalyst. It's happening, but it takes time. In the short term, global factors should continue to dominate. You know them: inflation, tightening, a strong dollar. They are simply too strong.
Drilling down to the UAE, in the past 12 months, we have seen a steady stream of IPOs here. Has this added new depth and liquidity to the markets? And what is the outlook for Abu Dhabi and Dubai equity markets?
Yes. First, let me say it without any ambiguity, we are overweight UAE stocks, and it's not because we are Dubai's largest bank. We actually had been neutral for years before, but now we are overweight. So, coming to the IPOs, they definitely improve market depth, but they also help putting the UAE on the radar screen of international investors, as we were saying before. The number of global IPOs is simply tumbling this year everywhere except in the UAE, which is a clear message of strength and confidence. At the market level, it increases the weight in global indices together with the trend of rising foreign ownership limits. The UAE is now larger than Qatar in the MSCI emerging markets and getting closer to the Saudi Arabia. Together, they combine over 7% weight and rising. It's not small. IPOs also enhance diversification with more sectors coming to the investors' menu, if you like. Abu Dhabi Ports, Borouge, Ferticlub, Yassat, Diwa, Ticom, now Sadiq, they all are high-quality companies with robust track record and high standards of governance. They are priced in a very fair way, given their cash flow and dividend generation, and of course, their growth. The pipeline now, in Dubai in particular, is rich with a total of 10 state-controlled companies, increasing interest from leading family-owned businesses with a market maker fund and a technology fund to help companies going to public markets. Now, I have a dream. Imagine that one day Emirates Airlines comes to IPO, the world's best and most successful airline company. This could be, I believe, for Dubai market what Samsung is for Korea, what LVMH is for France, or what Saudi Aramco is for KSA, an amazing flagship.
In Saudi Tadawul, which is the biggest regional market, valuations seem to be moderating, although earnings are forecast to slightly decline. Is this a good time to increase allocations to Saudi equities? What is your view?
Timing is everything, and when it comes to the long term, it's always a good time to increase Saudi Arabia. Having said that, in the short term, we prefer the UAE, and let me tell you a bit why. First, the Tadawul index and the KSA markets has always traded at a premium to other GCC and emerging market indices, and it still is, which is partially explained by the fact that there is a strong ownership and trading from domestic investors, including retail. Well, that's good news. If you invest in what you know, it means that there is some quality, but that's the reason for slightly more expensive valuation. Other important fact that we all know, Saudi Arabia is home to the world's second most valuable company, Aramco, with a market cap of more than $2 trillion. By the way, His Highness Mohammed bin Salman was right back in the days when he was saying that, and now nobody is arguing anymore. But it means that the index is a bit dominated by two sectors, petrochemicals on one hand, as well as banking stocks. It's evolving with recent IPOs, but it's still the case. So there are two obvious global drivers for this market: oil prices and interest rates. As long as the former stays above $70 for the Brent, and as long as the latter keep on rising, which it is, with banks directly benefiting, we keep a favorable stance for the market. But we have two nuances. First, global drivers will not always be supportive. And second, for the time being, we keep on favoring the UAE within the region with, we believe, more attractive valuation and more sector diversification.
That is good to know. Thank you, Maurice, for joining me.
Thank you for having me.
You have been listening to the Zawya Podcast.